Howdy, Jacob here. Today we're looking at Dropbox in the software industry, under 8 billion market cap, a little over 8 billion enterprise value. They provide content collaboration platform worldwide. Founded in 2007. I kind of think about them similar to maybe a OneDrive or a Google Drive, where they have a lot of space available. They have some free services, but you're really not going to get some immense benefit unless you use their premium features. But growth has been fairly impressive. It's definitely dampened down a lot. The year-over-year revenue growth has gone from 40% in 2016 down to upper single digit in 2023. So it's still like they have some, it still looks like they have some growth ahead of them, but maybe not nearly as much as they did 5, 10 years ago. Their gross margin has improved immensely, being as high as 81% in the most recent year, with an operating margin at 15%. It's also very impressive, and a return on invested capital that is very high, along with return on assets, both well into the double digits, almost guaranteed, well above their weighted average cost of capital, increasing business, which is great. And they have R&D spend, and their R&D spend has grown stupendously from 202 million in 2015, which was about 33%, maybe 34% of revenue, to 937, which is almost 40% of revenue. So 937, 2502, you're looking at, 37% of revenue in R&D. So they're spending quite a bit on research and development, which is taking money from now to hopefully get more money later, maybe efficientizing, maybe making your company more efficient, maybe finding ways to increase top and hopefully bottom line in the future. So not bad at all from that perspective. And again, that gross margin is crazy impressive, with cost of goods sold barely going up and their revenue exploding. The balance sheet has 1.4 billion, 1.3 to 1.4 billion dollars in cash-like products, with 1.4 billion in long-term debt. So they do have almost enough cash-like products to pay off that long-term debt. So we're not terribly concerned with that. I wonder if they made some big acquisition in 2021, or maybe just a big investment opportunity that they went into debt for. And we see that, okay, so they bought back a bunch of shares. They've been buying back shares like madmen. And they actually went into debt to fund that, which is peculiar. But they have paid it down a little bit over the last couple of years. Their use of cash is a little bit on acquisition, huge reinvestment, and humongous share repurchases. So, I mean, that might be enough for me to be ready to look at this share growth. I mean, again, I think competition is pretty grand here. I think some of those other big dogs kind of have an advantage when it comes to going against a Google Drive. You're facing Google, or OneDrive facing Microsoft, and you're talking about trillion-dollar companies, and you're only 8 billion market cap, making less than 500 million a year, and they make that in a day. I mean, possibly, definitely a week for sure. So, I mean, just interesting, but not to say the little guy can't win. I do think, to me, being a little bit conservative, I think 6% seems reasonable, given the fact that they do reinvest a lot. They do make acquisitions. I think they'll definitely grow beyond inflation with those items and with that investment capability, capital allocation. For margins, I do like that they're starting to make money on the net income side. I love that their free cash flow is consistently higher, but we will still do a pretty big range here, maybe 22 to 30%. With share repurchases, they buy back a lot. 80 million is about 1%, but they do have to offset this 335 million stock-based compensation, likely. And so, to be conservative, if they buy back, 500 million, that leaves about 150 million beyond the stock-based compensation, which would be almost 2%. So let's say 2%. Because again, not every RSU is going to be turning into a share necessarily, or stock-based option is not necessarily going to be turning into shares. And then with a PE, again, competition, they might have some growth ahead of them still. I'll probably go a little bit above market average, probably not too much though. And by golly, we're pretty close to a price that looks pretty attractive at this point in time. And so, yeah, I mean, capital allocation going towards reinvestment acquisitions to grow at 6%, have these type of margins seems very possible with an 80% gross margin. They've been buying back shares, hopefully at an advantageous price. I'd be interested. I'd be interested pretty soon. So I'm gonna have to do a deeper dive here. This will be one that I'll set priority on because it definitely interests me very much and something that I think I can understand pretty well. So I hope you enjoy the video and have a great rest of your day. Thanks.